Single family, especially your primary residence, is probably the worst financial decision. Let me just put that out there. Okay. Welcome back to Cashflow Marketplace. My name is Perry Zhang. I am here with Lynn. How's it going, Lynn?
I'm good, thank you, Perry. It's nice having you here as well. So last time you did talk about commercial real estate and residential real estate. So I wanted to dive into it a little further. Can you tell me what real estate syndication is?
Yes. So real estate syndication is the process of putting money together to buy a large piece of real estate that any single individual can buy. It consists of two parties. The first party is called the LP, the limited partner, and the second party is called the general partner, GP. Limited partner doesn't do any work. They invest typically $25,000, $50,000, or $100,000 or $200,000 into this piece of real estate. And then the second party, general partner, does all the work. They hire the property management company, they hire the legal counsel, they hire the CPA, and they manage it, and they will execute their business plan. And then finally, both parties share the profit and the upside.
Okay, so can you explain to me how does that work on the legal side of things?
Yes. So legally, it's actually one LLC that is purchasing the property. Suppose it's a 200-unit apartment complex located in Dallas, Texas. Legally, it's a single limited liability company that's purchasing the asset. Nobody owns the asset. Everybody only owns shares of that LLC. So what that means is that if the LLC does well, and this is a single purpose LLC, that LLC exists only for the purpose of buying this asset. It doesn't have any other purpose. And usually it has a class A is the limited partners and class B is the general partners. If the property does well, they will share the profit. If the property doesn't do well, it could potentially lose money. But I have not seen that happen very often.
So why does it have to be under an LLC to invest?
Great question. So the fact that it's an LLC means the limited partners are actually protected on the downside. So if you buy a piece of, say, Amazon stock, if Amazon doesn't do well, your exposure is only limited to how much you invest. The people, they do not come after your personal finances. So LLC gives that protection between you, the limited partner, and your personal finances. So say if you invest $25K or $50K, your exposure is only to that $50,000 investment.
Okay, that makes sense. It's like investing into stocks. You only lose the initial at the worst case.
Real estate syndication is basically turning real estate investing into a stock-like vehicle.
Okay, gotcha. So what is the benefit of real estate syndication?
Yeah, so first of all, let's talk about the returns between real estate syndication and other forms of real estate investing. Single family, especially your primary residence, is probably the worst financial decision. Let me just put that out there. Okay? If you read the Rich Dad Poor Dad, they will say primary residence, especially if you're buying a very fancy house, is a liability and not an asset. And I also believe that statement. If you house hack on primary residence, that's a different story. That's a great strategy. That's a great asset if you house hack. But not everyone wants to live with roommates. Okay, so a primary resident without house hack is very low return, high utility. Let's put it that way. And then if you buy a rental property, depends on where you buy it, but the average return is about 10 to 12% or 10 to 15% annualized return. Buying a single family is still better than buying stocks on average because you can influence the trajectory of that rental property. Your skill set matters to make that rental property go up or down. So it should provide a higher return and you get to learn a bunch of things. And so you're basically trading work for a slightly higher return in rental property. Then there is the short-term rental. Short-term rental is highest amount of work and also a higher amount of return. You are doing a ton of work, you are operationalizing it, you're hiring virtual assistants, you have to systematize things. Well, you are compensated for a higher return. And then there's the fourth one, which is multifamily. It turned out that a multifamily is about 15 to 20% annualized return for the last few years. That's a fantastic return, right? That's actually more return than my rental properties. In fact, I actually did a math that in the last few years, apples to apples comparison, I have a Airbnb I bought in 2019, and then I sold at the prime, which is March of 2022. My IRR is 27% annualized return, which is really good. And again, this is like the prime of real estate investing in Seattle, in one of the best cities at one of the best time periods. At the same time, I did a syndication, and the return for that one as a limited partner, and this is someone who doesn't do any work, right? So this is after all the fees, it's a 94% return over the course of the same period. So it's actually a 35% annualized return. So you can see if a real estate syndication does well, the LPs actually get almost as good or even higher return than if they are operating an Airbnb. Now, you might say, wow, Perry, that's like too good to be true. How is that possible? It's because the multifamily is managed by general partners who actually put their operational excellence on display. A lot of the renovations we do on multifamily, it's actually that a general partner who has a ton of experience will, for example, let's talk about renovation of these units. They actually will import the materials directly from overseas, put it in a port, ship that to the unit, and then put them into these crates. They open up the crate. That crate contains all the materials needed for that unit. They have their on-site manager. They have their on-site maintenance folks that can do renovations as well. Essentially, as an LP, the higher returns come from the expertise of the GPs and from the economy of scale. When you have many units, things just get cheaper on average. And then the LP is benefiting from those operational efficiency gains. If you can do all the expenses 80 cents on the dollar, you are expected to get higher returns.
Wow, investing as a limited partner, that actually sounds really great. But that sounds great, but can you tell me about the risk? There has to be some kind of risk.
Yes. The biggest risk is that you don't know before you invest as an LP into a general partnership how good that general partner is. So your biggest risk is actually not on the real estate. Your biggest risk is on whom you want to partner with. In essence, as an LP, their judgment is not really on how good this real estate is. That's part of the judgment. Their biggest judgment is how good the general partner is. In real estate syndication, jockey is way more important than the horse. It's 100x more important than the horse. And in essence, to be successful in real estate syndication as a LP can be reduced to a problem of judgment on people. Let me repeat that. To be successful as a limited partner in real estate syndication, you can reduce the problem of real estate investing into a problem of judgment on people. And we can talk about next time, how do you judge if a GP is good or not?
That sounds good. Yeah, I would definitely like to know more about that, because you did mention that partnerships are most important and would be the key to investing.
Let me actually add a little bit more on the risk, because I am honest and there are risks of real estate syndication. The first risk is that if the GP doesn't have high integrity, they may not put the full effort into renovating it according to business plan. The second thing is they're not as competent. They drop the ball. They're not able to influence the property management company. And so the property actually doesn't do that well. The third one is they don't have good judgment on the reality and they overpay for the property. And there's no way the LP really knows without knowing their track record and the way they communicate themselves. And then the fourth way is, at the end, you're still buying a real estate. It still has renters. It still has a profit and loss statement. It still needs good operations and it needs good operators. So at the end, if that GP is not able to execute, the whole property could break even or lose money. Now, in the last 5 years, almost all real estate syndications or multifamily get saved by the buoyancy in the market, right? Even if the operator is not so good, the market carried them. But what I do know is that the best operators not just perform well, but they also perform well compared to the market. So a sucky operator could say, okay, the last few years, I get a 15% to 20% IRR, and they call that a win. That's only because they got saved by the bull market. Whereas a really good operator did not achieve a 20% annualized return. They actually did like a 35 or 50 or 37% annualized return. Now, obviously, disclaimer, good operators are still human. They may start off making some mistakes. They may not make the best choices always, and they may not pick the best markets. But the good operators, just like any other competent humans, they learn, they adapt, they iterate. The point I'm trying to make is that in real estate syndication, you don't have to learn all of those skill sets if you don't want to. You could go in, and then people who are passionate about this like whole real estate syndication industry, they will do the single family, they will do the rentals, they will do the Airbnbs, and then they're like, okay, I arrive on syndication. I want to get a PhD in real estate. And that's why they want to become a general partner. But not everyone wants to do that. And so the goal is it will be super nice if the people who don't want to do that yet want to enjoy the benefits of that. That's what real estate syndicating is about.
Gotcha. Yeah, that was a great explanation, and I'm sure people like me that doesn't want to do all of the X, Y, and Z that you just explained may be interested.
Absolutely, that's right. Thank you so much, Lynn. And if you want to dive a little bit deeper into the benefits between single family investing and multifamily investing, check out our next episode. Thank you.